Okay, I think we're starting to steady down there, but I'll keep an eye. So yeah, welcome to today's Talk Power webinar. This is our first one of 2024. So James Chaplin, Senior Manager of Curve Trading, is going to talk through the power market and the latest updates on what's driving costs. As usual, we'll be recording the webinar today, so we'll share this with everybody after, so you can watch again, or to those that aren't joining us live can catch up on demand. We will have a section for Q&A at the end, so once James has finished talking through his slides, but please feel free to pop anything into the Q&A function as we go along, and then we can pull those out at the end. So yeah, I think that's it. I'll hand over to James. Thank you, James.
Yeah, thanks, Penny. Good morning, everyone. Thank you for joining today. As Penny said, I'm James Chaplin, Senior Manager of the Curve Trading team at EDF here in the UK. For those who are new to this webinar, we run it every quarter, and it's just to give you a brief 20 to 30 minute overview of what's happened in kind of UK power and gas markets over the last few months, a bit of our outlook on fundamentals, and to see what risks there are still about in the market. So if I jump ahead. Right, so if we start by looking at UK power price development, now this goes back to February last year, looking at a few kind of key forward contracts. We've got March, Q2 and the front two seasons. Last time we spoke in November, so we focus on the right hand side of the chart. You can see it's been quite a bearish picture overall. Prices have continued to fall quite drastically over this time as well. Not too noticeable in the graph. We have seen some periods of some volatility, some upward price movement, but overwhelmingly it has been rather weak in kind of the UK power and gas markets. So focusing a bit further in on kind of the last 3 months here. So this is just actually looking at actual trade gas prices. So this is just a kind of a benchmark. So front month gas contract, the March contract. As you can see, I mean, most of this bearishness from last time we spoke came really from the very beginning of December. So we did have a bit of a cold snap to end November, kind of went into the very first few days of December, but then fundamentals turned quite weak. We had a turn to quite mild and windy conditions, and that was across Europe and pretty much all through December as a month, and that continued to price risk out the market. We already had quite a mild start to winter in October, a bit of cold in November, but then December being mild as well, along with the very high gas storage levels we saw coming into winter. It put us in a fairly comfortable place. You're getting through December without having to really rely too heavily on European gas storage levels. On top of that, all the geopolitical risks that kind of came about in October, although still ongoing, some LNG diversions around the Horn of Africa instead of going through the Suez Canal, limited impact in the market overall. So the market kind of was pricing this risk out at the time as well. If we move into January now, again, it doesn't look too drastic a price move when compared to the rest of this chart, but we did see quite a bit of bullishness over the first week or so of this year, and that was, again, it was just kind of changing weather fundamentals. So we actually had a shift from quite mild conditions to actually quite cold weather overall. We initially saw forecasts seeing cold out until early to mid-February, so potentially a 4 or 5 week cold snap at that time. Along with that, there was a high chance of an SSW event as well, so sudden stratospheric warming, which usually brings with it higher chance for prolonged and more severe cold. So SSW is what brought us the beast from the east in 2018. So this added a bit of uncertainty to the market. At the time, we're looking at kind of balances for this year. So kind of how oversupplied are we going to be for summer 24? And even at seasonal normal conditions past mid-January, you're probably looking in the range of 50 terawatt hours. And to put that into perspective, European gas storage capacity is 1,100 terawatt hours. So it's not a great deal of oversupply. It won't take too much kind of weather risk for the rest of winter to erode this, some supply uncertainties or so, to flip essentially the European gas market from long to short, and essentially then add more risk in potentially for the summer, but definitely for next winter as well. So market probably was a bit fast to sell off after this spike up until kind of the 8th, 9th of January, but fundamentals did kind of, I suppose, convince the rest of the market eventually as well, where we did have initially a 2-week period of cold weather in January. You didn't have the outturn of that 5-week cold, which was forecast. The SSW event didn't actually outturn, and we didn't just turn to mild conditions by late Jan. We turned to extremely mild conditions, which we'll touch on a bit later in this presentation. And again, this continued through February. It's been, I think probably everyone can agree, it's felt very spring-like over the last few weeks. So very mild conditions continuing. Again, what comes with mild weather is very windy weather as well. So we've got more wind generation on the system over the last few months. And this really weighed on sentiment. And again, looking, kind of referring it back to that, the balance forecast for summer 24, we were seeing about 50 terawatt hour overhang at the beginning of the year. Now, with the mild weather persisting through mid-February, that kind of flipped from 50 terawatt hours to about 120 terawatt hours. Obviously, lots of variables, lots of risks in that forecast, are very ballpark figures, but it kind of really swung how much extra supply we're going to have, because we didn't have to draw down on storage quite so much. Now, I don't have the chart to explain this, but it's probably over the last 3 weeks, it's probably one of the biggest swings in winter weather forecasts I think we've ever seen. So going back to around early Feb, around the 5th or 6th of Feb, the weather forecast for I think it's around the 12th of Feb onwards that week, we saw temperatures about 1 or 2 degrees below normal forecast. I think Germany overall was forecast to be around 0 to 1 degrees on average. However, outturn, considering it was only forecasting 7 to 10 days ahead, outturn averaged around 11 to 12 degrees. So you're talking over a 10-degree swing upward in weather revisions, and that swing, definitely so late in the season with cold risk into March really subsiding, it really kind of swung the balances quite a lot. And obviously led to that further bearishness down to sub 60 pence per therm, which we're trading at today. Obviously, there are still some winter weather risks ahead, but we are so late into the season now that it is going to be constrained. I think we are actually going back to around seasonal normal over the coming days, but that's mainly contained to the UK. Germany is still going to see quite mild conditions. March isn't expected to be overly cold or overly mild. We're expecting a seasonal normal March, and therefore, you're getting so late in the season that the risk of any cold really kind of goes out the market. Now, we had a look at both kind of power contract, briefly a bit on gas. I haven't talked about carbon. Carbon has also been quite bearish. It's generally an oversupplied market. So carbon prices in the UK have come off to the low £30 per tonne level. But the other element, which I don't think we've talked about too much over the last few webinars, is clean spark spreads. So clean sparks, for those who aren't too sure, essentially it's a profitability of a measure of profitability for a gas station. So it's essentially a gas station needs to buy gas, needs to buy carbon certificates and sell power, and it's the spread between those levels based on their efficiencies. Now, this is looking at clean sparks or baseload clean sparks for the next 2 seasons. So in orange, you can see the summer 24 has been trading negative for quite some time. It is deeply negative at the moment, over minus £5 a megawatt hour negative. Winter, on the other hand, typically always trades positive. You have extra demand in winter. You need your gas stations to run, need them to be profitable and to kind of meet demand. What we have seen over the last few weeks is even the winter 24 this early on go quite negative as well. So one of the big drivers for this is just the massive renewable penetration we're seeing across Europe. A lot of wind generation on the system, a lot of solar in the summer as well. We just don't need gas stations running on a base load perspective. And we're seeing a lot of gas stations getting quite aggressive in the market, selling baseload clean sparks maybe uneconomically, knowing that there's going to be further value in reoptimizing this at a later date. So the baseload might not be in the money to run, but in the summer they'll be in the money definitely for the block 3 or the block 6. In the winter they'll be in the money for the peaks or the extended peak times as well. So it'll be interesting how this develops. Definitely for the winter contract if it goes back to positive. But again, it's been another one of these bearish sentiments weighing further on power prices. You can, I suppose, compare beginning of winter 24 spark was trading around £4. It's now -2, so that's a further £6 downside we've seen just from the clean spark impact. So going on to fundamentals, and I'll talk around a series of kind of supply side and a couple of bits about demand here. And also, as always, start with European gas storage. So we're going to pull it back to this perspective. So this is just looking at European gas storage levels over kind of the summer winter periods over the last few years. So we got the range in 2018 to 21, what we saw in summer 22, winter 22. So that blue line, obviously we came into that summer very low storage levels. We had a lot of work to refill and without stable Russian pipeline supply. And big concerns in the market: are we going to be able to refill before winter? Are we going to have enough gas for winter? We actually had to refill until kind of mid-November to get to pretty much tank tops, and it was quite lucky we were able to do that because we had a very, again, winter 22, we saw a very mild start to winter in October and November. We didn't have to rely too much, again, mild conditions, demand erosion particularly last winter, and we ended at a very good level, over 600 terawatt hours. Really took off the risk for summer 23. So you can see that red line towards the left hand side of the chart coming into the summer, very well stocked. Didn't really have to put too much supply into the system to fill up storage. There were talks at the time of, are we actually going to have too much supply? Are we going to see gas prices go down to 0p in the prompt at times as well? Are we going to see US supply shut in? We didn't see that, but we did get to tank tops. You can see that red line reaching the highest it's been kind of in this period. Now, storage withdrawals so far this year, we have seen some times where rates have been quite high. Obviously, we had a cold snap in kind of late November time and early Jan. Other than that, it's been fairly mild. So actually, we haven't needed to rely too heavily on gas storage. And therefore, we're actually sitting slightly above where we were this time last year, which is a much, much better situation than we thought we'd be in at this time. I think we thought we'd be quite a lot lower from this. And again, we'll relate this to when we actually see the temperature charts in a few slides' time. I suppose the forecast for this, we are returning to more seasonal normal temperatures over the next week. March, I think the best forecast at the moment is roughly around seasonal normal, plus or minus 1 degree. So we should end this winter pretty much in the same situation we had last year, over 600 terawatt hours, maybe around 620 terawatt hours. And that's kind of where, depending on demand forecasts for this summer, LNG supply situation as well, we might see some kind of oversupply dynamics, and we'll have to see the market adjust in that. The one thing I think the market is conscious of is, with prices coming down to such low levels compared to the last couple of years, kind of more historic norms, how much demand are we actually going to see return to the system? Are industrial players going to start ramping up their demand, taking advantage of the low price environment? So next, on supply side, just quickly on this one. So European LNG imports by month and by source. I think the two kind of takeaways from this, if you actually look at the dotted line, which is the yearly average, 2023 we averaged just below 2022. It wasn't that more, we didn't need the supply. It just, in summer we were so well supplied. You can see that kind of turn down from June to September. We didn't need to attract all that LNG over that time. When we did need that LNG, kind of November, December, January, you see the supply has been quite strong. Most of that supply has come from the US. There is, however, obviously quite a substantial grey bar still, and that's from Russia. There is, I suppose, this is probably one of the uncertainties over the next year. What is going to happen to this Russian supply? Is the European Commission or separate countries going to come out and essentially rip up their contracts or ban Russian LNG imports and essentially take that supply away from Europe and tighten things up again? Or are we going to still be okay continually taking Russian supply from LNG? Obviously, pipeline supply has been massively turned down. LNG not really impacted over the last few years. Right, so next look at obviously map the globe. Each of these orange dots essentially represents an LNG tanker. So this is actual real-time data from this morning. You can kind of see the kind of supply routes around the globe. So you've got big liquefaction terminals in around kind of the Texas region in the US. You can see supply coming from there heading towards Europe. Another supply line going around the Horn of Africa towards Asia. You see lots of supply coming from Qatar and from Australia. Most of that heading towards Asia as well. Now, the reason for bringing this up is to focus on kind of these two points here. Now, I'll talk about the one on the left because probably less talked about in the news than the other one. So the one on the left is the Panama Canal. Now, Panama Canal is used obviously a lot for US or East Coast US shipping supply across to Asia. So it's a bit of a shortcut instead of going around South Africa or around the Horn of Africa. They can cut through the Panama Canal and at a much cheaper rate, much shorter duration time, supply to the likes of Japan, China, South Korea, LNG. Now, they've been having some issues with water levels. It's been very dry over there. And essentially, they can't put many ships through the Panama Canal at the moment. You can see it's not a very busy junction currently. Now, this is supposed to ramp up. I think they are supposed to ramp up maybe back end of March into April time. Water levels are supposed to rise. And therefore, we could start to see some more competition for US LNG cargoes with Asia. The spread, the premium Asia would need is much less with the Panama Canal open. So again, one to watch. But yeah, the traffic through there has been quite limited over the last few months. Potentially definitely should ramp up over this summer. Now, the area towards the right, obviously, I think everyone's heard about this in the news. The Houthi attacks in the Red Sea. And what's important here is the Suez Canal. So typically, Qatari cargoes will be shipped to Europe through this route, through the Suez Canal, and supplied to any European country. They are avoiding this completely at the moment. You can probably make out some supply lines actually going around Africa to Europe, which adds a lot of cost, a lot of duration in actually supplying the LNG, and therefore they can actually do less trips as well. Now, this is just looking at LNG tankers. There's still lots of oil traffic going through there. I think the key point is if a missile hits an LNG tanker, it's a lot worse situation than if it hits an oil tanker. So that's why straight away when the attack started, LNG tankers essentially started avoiding this route. Last slide on, or second last slide on supply actually. So Norwegian supply, obviously very important to Europe. I don't have kind of past supply actuals in here, but through 2022, Norwegian supply was very high. Obviously, Russia turned off a lot of pipeline supply during that time. And Norway kind of stepped in. They cut down their maintenance schedule. They pumped as much as they could through 2022. As a result, they had to go on outage at a far greater rate for last summer, in summer 23, just to kind of make up from kind of missing some maintenance schedules over the last year. So heavy Norwegian maintenance in summer 23. Fast forward to this year, it's kind of a more normal year. So again, we can't, you have to take my word for it, can't compare it on this chart, but this is their maintenance schedule over this year. But it's far less than what we've seen last year. So we should see more Norwegian supply than summer 23. And again, that's adding to that extra supply situation we're going to see over the next few months. I suppose the one risk to this, like we saw last year, is any kind of outages or any kind of hiccups in this. I think last year we saw Troll come off for an extra month or so, which took about 30 terahours or so out the stack. And last slide on supply. So this is, I think we look at this most webinars looking at French nuclear output. Again, got the range from 2016 to 21. 2022, that was the interesting year where not only did we have the gas supply issues and crisis going on, nuclear capacity or output in France was very low, as you can see, compared to historic levels. It ramped up towards the end of the year, but there was concerns that if it actually stayed low through winter, we had some, cold weather, high demand periods. We were going to see rolling blackouts across France and across other countries as well. Thankfully, that didn't happen. Supply started to come back on in 2022. Then that blue line in 23, it was fairly robust through the year, and 24 we're expecting even stronger nuclear output as well. So started the year in a good situation, that red line so far, and we should kind of track the general trend. Again, one to watch. We know how sensitive the market is to kind of bad news at the moment, but it's looking quite a robust situation in French nuclear output currently. So that's all on supply. If we look at a couple of charts on demand first, so already talked about this quite a lot. So this is looking at temperature delta to normal. So how much have we outturned above or below seasonal normal so far this winter? And the three bars we got are UK, Germany, and France. And if I start by kind of talking through the months starting from October, obviously October is a very interesting month as we come into winter. It really sets the tone for the rest of winter. If we start winter cold and we have to, start on storage withdrawals quite early on, that does really add a lot of tightness. You've still got 5 months of winter weather risk left, and people get a little bit panicked. Thankfully, in October 22, we started very mild, and again, same situation this year where UK was around 1 degree above average, but continental Europe even milder. Germany, France up to 3 degrees above normal, and that really meant that we didn't have to start storage withdrawals in October at all. We actually started withdrawing, I think it was around the 7th of November or so. Now, November, a bit more kind of seasonal normal. We had mild start to the month, colder end to the month, still kind of continental Europe finishing higher than average, just the UK outturning a little bit colder, nothing too drastic there. Go into December, and as we said before, again, overall mild conditions persist up to 2 degrees above normal. And by this point, we're already most of the way or part way through winter. A lot of risk started to get priced out of the market as European storage levels didn't really have to be relied on to a great extent by the end of December. January, that's when we saw the 2-week cold snap, and although it was forecast to go on longer, it only lasted those 2 weeks and then turned very mild towards the back end. So even though we saw quite cold even in Germany and France, that mild weather at the very beginning and the last week or so actually meant those countries still outturned slightly above seasonal normal. And then February, just caveat, this isn't a full month of data, it's from about 2 days up to about 2 days ago. But you can see quite how spring-like and mild February has been. I can't remember seeing a milder period. I'm guessing it has to be the mildest February on record in Europe. But yeah, you're talking around 3.5 degrees above normal for the UK. Germany up to 5.5 degrees above normal. So this has swung balances massively, and obviously meant that we haven't had to rely nearly as much on gas storage than we thought we were going to. And then the other kind of demand dynamic, which I suppose is a bit more uncertain going forward, is gas demand destruction or gas demand erosion, whatever you want to call it. So this is an estimated measure from 2022 and 23. I've just taken Germany here as kind of a basis. Obviously, Germany, biggest gas demand country in Europe. 2022, when we had all kind of the issues, we had to rely on demand erosion to get through. Obviously, we did have some extra supply from US LNG, which kind of helped balances, but it was really how much demand was eroded in Europe that helped ease prices and kind of balance the system there. So you can see up to 25% demand erosion in some months. And just to caveat, this is weather adjusted, so it's not kind of biased due to mild weather. 2023. We're seeing some demand return now. Obviously, we're still seeing quite high levels of demand erosion, but you can see the trend coming back. Now, I suppose to me, there's two elements of this. You kind of got more your residential tariffs, where some behaviors will constantly be changed and demand might not ever return to what we see as pre-crisis normal levels. But the lower price environment potentially will attract a bit more usage back as well. There probably is going to be a bit of a lag to this as well. I mean, just the UK as an example, most people will be on the price cap. Most of the price falls will come into effect actually from this April. They're not actually being seen this Q1 to a great extent. The other side is industrial players as well. So with prices coming down to kind of more normal levels, are we going to see a lot more demand return from business and industrial users as well? So I think over this year, we're forecasting around, or across Europe, we're forecasting around 2 to 3% increase in demand. That was from the IEA. But again, it will be interesting how this develops. Are we going to see more demand come out the woodwork with the lower price environment? And is that going to essentially tighten balances and use that extra supply we're getting from Norway and use that kind of extra supply we're getting from some US LNG as well? And that's all kind of the main slide. So just to summarize, I mean, again, overall mild and windy weather conditions have prevailed this winter, and it's meant that we just haven't had to rely really too much on gas storage withdrawals, not as much as we thought we would have to. So we're looking to end this winter at pretty much the same place as last year, so fairly comfortable for now. But as always, there's always areas to monitor. European demand is going to be one, so demand destruction, what we just talked about, how much demand is going to pick up in the lower price environment from either residential, business or industrial users. And also winter 24, obviously been talking a lot probably around this summer. Winter, there's still going to be lots of risk around. We've been very fortunate the last 2 winters where it's outturned very mild. So even a seasonal normal winter puts a bit more strain on the system. And we are going to flip from overall an El Nino weather system to La Nina, which means potential for colder weather as well next year. So we'll see how kind of that develops. But yeah, just I suppose caveat, you know, we've had 2 very mild winters. Not to say that's going to always be the case going forward. Asian demand, I think there's probably even more uncertain. Economic outlook isn't actually fantastic in China at the moment. But if that did improve, their rate of LNG demand interest, definitely at the lower prices, could suck up a lot of the global oversupply as well. And again, we're talking about oversupply for this summer. It's not going to take much currently to flip the overall global market from long to short. You know, we're not talking about structural overhang. We are still quite a structural short market. So it's not going to take much to flip it. And Asian demand is definitely one to keep an eye on. And the last point, geopolitical, I suppose has gone quite quiet in terms of risk over the last few months. But there's still plenty of things which can happen over the next few months. I suppose one of the key things I haven't mentioned is lots of kind of the Russian gas contracts, pipeline contracts with Europe at the moment. I think the Russia-Ukraine gas transit agreement is due to end at the end of this year. I don't think there's desire on either side to continue this. So again, that's potential supply we'll lose from the beginning of January next year. The Austrian gas monopoly at OMV, they're looking to get approval to essentially take out the Russian supply. I think they're supplied around 95% by Russian supply at the moment. They want to break that contract as well. So any kind of changes there, what we talked about earlier around Russian LNG, if that supply goes, it can tighten things up quite quickly. And that's it from me. And now open for any questions.
Thanks, James. Just having a look to see what we've got coming in. Yeah, so just remember, if you've got any burning questions, please drop them into the Q&A function and we can run through those now. I think whilst we're waiting, we can go through some that we had pre-submitted ahead. But before I do that, there was one quick question just to confirm something on your side, James. We've had a question saying, are the dates correct for the German gas demand destruction? I think the slide might have said 2022 to 2023. Is that correct, or is it 2023 to 2024?
So yeah, it should say it's looking kind of winter, start of winter 22 and start of winter 23. So yeah, so kind of crosses over a few years, but yes, it's the more recent data from start of last winter.
Fab. Okay, thank you. Then there's a question, what about the recent decision of reduction of gas production in the short term in the US? Should it impact the prices?
So it shouldn't do initially. It depends kind of how much more goes on, but essentially the US is looking very, very oversupplied in its domestic market. And we've seen the Henry Hub price, I think maybe 4 weeks ago, we were trading over $3 per MMBTU. We're now trading for the March contract. We're trading around, it got down to 1.55 as a low. So this is under the break-even price for some producers. And therefore they're reducing how much gas they're going to produce this year. So I think it's just normal market dynamics. You're not just going to continue to pump out as much gas or increase the gas production if it's not profitable to do so. It's just the market adjusting to the price. It shouldn't impact US LNG exports to Europe because they're well in the money. But also the Permian Basin, the kind of the supply that actually ships to kind of US to LNG tankers will have a lower break-even cost as well.
Okay, thanks, James. So another question: why hasn't Russian LNG imports been impacted by the restrictions imposed on Russia as a result of the war in Ukraine?
Oh, sorry, could you repeat that, please, Penny? Sorry.
Yeah, of course. Yeah. So why hasn't the Russian LNG imports been impacted by the restrictions imposed on Russia as a result of the war in Ukraine?
Yeah, so very good question. They've just been left out. So I think the European Commission passed earlier this year or late last year that each country can decide and essentially stop importing Russian LNG if they like. But no country has come out and said that. I think actually Italy said by the end of this year they might stop importing Russian LNG. But essentially Europe needs the gas. So it's kind of gone under the radar in terms of sanctions, where we're stopping a load of pipeline imports, but actually we're still getting a lot of supply from other means. But yeah, definitely one of the big risks going forward. If anything happens on further sanctions or Russia decides to stop flow, that's a lot of supply to come out the balance stack there.
Okay, thanks, James. So whilst always challenging to predict, what is your view of the next 12 months forecast for energy costs?
Yeah, so unfortunately we're not allowed to provide views on kind of market price evolution. I think what we touched on in the presentation hopefully gives enough information to form your own opinion. There's always going to be lots of changing parts, as we know. As we said, this summer's looking quite comfortable. Looking in an oversupply situation, we were last year as well, and the oversupply quickly eroded out. We talked about some of the risks around kind of the potential sanctions on Russian LNG. Demand returning is going to be very vital as well. So yeah, we'll see how that develops. Winter 24, again, it's probably the same situation. We're looking to go in fairly well supplied in European gas storage levels, but we're still going to have the same risks around those Russian LNG. We're going to have the same risk around weather as always. Back end of 2025, that's when we get more LNG, US LNG projects coming online. So that should add to global supply. But again, we'll see kind of if those projects get delayed. So yeah, unfortunately, we can't give our own view, but hopefully what we've presented today gives a lot of information to go by.
Thanks, James. Another question: is there any alternatives to the wholesale market to secure the commodity part of the price?
I suppose corporate PPAs are one way to go. So to get direct kind of link to kind of PPA off taker. But yeah, that's it.
If anybody wants to find out actually a bit more about corporate PPAs, you can reach out to your account manager actually, or that will give the address, the email address at the end of this webinar anyway. So feel free to get in touch. Another question that's come in: so would a change from Biden to Trump as US president at the end of 2024 introduce more risk into pricing, or has that already been factored in?
Yeah, I don't know. Who knows what will happen if Trump gets back in? It would definitely shake things up. Yeah, but I haven't given it too much thought, to be honest. But yeah, there probably will be a bit of a change in something. But who knows? Maybe less support for kind of shipping through the Red Sea, as obviously the US has got a lot of ships there. But yeah, we'll see. We'll think about it more if it becomes more realistic at the time.
Very good, thank you. So I think, is there any other questions? Just do a bit of a refresh, make sure I haven't missed anything. Obviously, if you think of something afterwards, we will share our email address now, so you can get in touch. Also, if you wouldn't mind, just to help us continue to improve the content that we're delivering, I've popped a quick survey in the chat if anyone would have time, just to give us a bit of feedback on today's webinar, so that we can take your valuable feedback on board and see if there's anything else we can deliver through our program of webinars. But just here on the screen, here's what we've got coming up next. So we've got our Monitor Explained, so where we'll look at what's driving non-energy costs. So that's coming up on the 14th of March. So yeah, if you head over to the Talk Power events page, you can register for that one, and again, get the opportunity to ask questions to the experts. And then, as you can see, we've got a whole series of webinars already in the calendar across the year. So feel free to go and register to any that you can join or would like to join. And there's our contact details to get in touch if there's any questions that you think of after today for James or any of the team. So that's Let's Talk Power at edfenergy.com. And if you don't already, follow our EDF Business Solutions LinkedIn page. We're always keeping things regular and up to date on there. I think, thank you, James, so much for today, as always. Really useful webinar. I think you may have had one last question come in, or is that, no, maybe not, sorry. I think it looked like we had something come in, but we haven't. But yeah, if anyone thinks of anything, do get in touch. But yeah, thank you once again, James, and have a good day, everybody.
Thanks all.
Bye.